Hi, everybody. I made it on time. Isn't that amazing? How is week 3 going?
Going okay. Having issues with homework, though.
Okay, all of the homework or part of the homework?
Just 4 and 5. Just if I had an example for the overhead ratio on how to get that with the practice problems that gave it to you, and for some reason I can't figure it out.
Okay. Okay.
Everything else is going fine now.
Yeah, there's a problem like that on the test, and we're going to work one like it tonight.
Perfect.
Okay. So what I want to do is there's not, most of the next chapter, the 3rd chapter for this week is informational. So I'm going to go over the important parts of variance analysis, and then we're going to work with it by working problems for the for the test, so we can practice. And I'm going to apologize ahead of time because I'm sick. I'm like losing my voice. I'm coughing, so just bear with me. Okay, let's go, shall we? All right, so remember we talked about a little bit about on Thursday, we looked at budgets, and then we looked at flexible budgets, and then we talked about a little bit about how we were going to use variance analysis to tell whether, to compare like what we budgeted against the actual results. And where you start with this is you would look at the balance sheet and the income statement, and you would simply look at, you know, what are the actual results and what were the budget, and you're going to see one number. So you'll see, you know, one number that we're either, you know, over or we're under. You're not going to be right on the money probably, unless it's a fixed cost. So you're going to see one number, I'm over, I'm under, and then you're going to go investigate that. If your actual cost is more, by the way, okay, so with this unit, with this chapter and this test, it is really helpful if you remember the things that you already know, because these are not, I mean, they get mixed up with all this new terminology and everything, but these are not things that you don't know. I mean, it's like if you plan to spend $100 at the grocery store and you spend $120, you know that you spent more than you planned to spend. This is exactly the same as that. So these budget items, the differences between what we planned to do and what we did, are things you're already familiar with in your own life. So if the actual cost is more than the standard cost, and the standard cost is simply what we budgeted. So if the actual cost is more than the standard cost, if we paid more than we planned to pay, then we have an unfavorable variance. If the actual cost is less than the budgeted cost, so if it ended up costing us less than what we planned for it to cost, then we have a favorable variance. Now, the next thing we're going to do, though, is we're going to break that variance into 2 pieces, because the first thing you'll do is you'll look and you'll see, where is there a variance? And then you'll go investigate, you know, why is there a difference? But the next thing that we're going to do is we're going to look at the differences, and when we have either a favorable or an unfavorable variance, then we want to figure out, is there a variance because we paid more than we planned to pay, or is there a variance because we used more than we planned to use? So if it was labor, did we, you know, like use more hours to get the job done than we had planned, or did we pay more? You know, where's the problem? Is the difference between our budget, because our budget is built based on, you know, like, okay, so how many labor hours do we plan for it to take, and how much are we going to pay? When you look at your financial statements, we have one number for labor, right? But if you look at the budget, we got that number by taking the number of hours that we plan to have times the dollar amount per hour that we plan to pay. So when we look at the variance, it's, did we use too much labor, or did we pay too much for the labor? with materials, it's did we use too much materials, or was it what we paid for the materials? And if it's overhead, it's did we use more overhead, or did we, pay too much? Are we paying too much for one of the, some of the overhead? So the good news is that's as simple as it is. I'm going to show you 3 different techniques for getting to the same answer. Some people light up when they see formula. Some people light up when they see, it put into I like the format I'm going to show you. All right, so this is what we're going to do. So what we have to do to figure out whether it's the quantity or the price is we have to separate the price and we have to separate the quantity. So like if you look at the first line here, for the cost variance, we're taking the actual cost times the standard cost. So we have actual and by standard, and then we're going to compare. This is the one I like to show for comparison. Okay, so look on the left. We have what we're doing here. So let me. Okay, so when we look at this, what we have here. Why is my pen not responding? Okay, it is. All right, so we have on the left-hand side, really? Says not responding, just give it a moment. Really? Oh, no. Really? Okay. Okay, so when we sorry. All right, so here we are, we've got both. So go. Erase my random scribbles. All right, so when we look at the left-hand side, this side we're comparing cost, right? And this is actual. So here we want to figure out the dollars, the price. And the way we're going to do that is here we've got actual quantity times actual price, actual quantity times standard price. So what we've done is we have separated, we've done the actual, and standard price. So the only variable here is the difference between the price that we actually paid versus the price that we plan to pay. And that gives us our price variance. So whatever the variance is on this side has to do with how much we paid for the labor or the materials or the overhead. On this side, we're looking at quantity. So this is how much. So we're doing that by saying, okay, here's actual quantity and everything else is standard. So standard quantity times standard price. Standard price. What we're separating out is the actual. And so that's how we're separating out the quantity for here. And then on this side, we're separating out the price. So what we have is when we combine these two, we get the total variance. And this is what we'd see on the financial statements, right, is the total variance. And then when we analyze it, we'll break it down into either price or quantity. Now, if you like formulas, here's the formula. All we're doing is we're saying the actual price minus the standard price times the quantity. So all that really is we're saying, okay, let's say that we plan to spend $12 an hour, but instead we paid $13 an hour. If I asked you, is there a difference, do I have a variance in how much I paid for labor, you would clearly know right away, yes, we have a variance. We paid too much. We planned to pay 12, we paid 13. So we paid too much. That's all we're doing here. We're saying, okay, so we actually paid 13. we plan to pay 12. So there's a $1 variance times however many hours we worked gives us the total dollar amount. That's all we're doing. And over on this side, all we're doing is, okay, so this would be like, we worked too many hours. We planned to put, 15 hours into the job, but it took 18. Okay, so the actual quantity was, 18 hours. We planned for it to take 15. So clearly we're over budget by 3 hours. You know that just by reading the information. Times the total number of hours so that we can figure out the total dollar amount, the total number of hours that were off for quantity. All right, 2 ways of doing it. Are we good so far? For looking at examples?
Yes.
Okay. All right, so we're going to look at materials and labor, and the good news is all of them work exactly the same. The biggest thing is just getting getting in your head what the data is telling you. So like here, GMAX company makes golf club heads. So we know that our direct materials are 0.5 pounds, $20 per pound. So, and this is planned, this is our budget. Because this is standard, right? So we plan to spend $10 in material per unit. We plan to use 1 hour of labor at $16 an hour. So we plan to have $16 worth of labor in each one. So we planned for the cost of each golf club head to be $26. That's our budget. Are we good here?
Yes.
All right, so now let's say that during May, we produced 3,500 golf club heads. We used 1,800 pounds of material, and we paid $21 per pound. So the first thing you know right off the bat is, did we pay too much for our materials? What did we plan to pay? Plan to pay $20 per pound, right? We paid $21 per pound. So we know we paid more than we planned. All right, so now we're going to put this in this format. So we used 1,800 pounds. So this is what we actually used, right? So we're going to go over here and we're going to fill in actual quantity, 1,800 pounds. Actual quantity, 1,800 pounds. Okay, now when we go back here, we're like, all right, we paid $20 per pound. So actual price, right here, right? We paid $21 per pound. So for the actual cost, we're going to take our actual quantity times our actual price. So this is what we actually ended up paying. So 1,800 pounds is what we actually used at $21 per pound. We have a cost of $37,800.
That was playing
Okay.
really loud, and now he's eating ice cream out of the container without using a bowl.
Ask Kelton to come up here, please. Okay, now, so that's actual. Now, in the middle, we're going to say, here's the actual quantity. We actually used 1,800 pounds, but our standard price was $20 per pound. So when we look at these two numbers, what we separated out is the price. So we can see that this $1 a pound times 1,800 pounds created an $1,800 price variance that's unfavorable because our actual amount is higher than our planned amount. So this is like actual, and this is our budget. So what we really have is this $1 times 1,800 pounds. gives us this $1,800 unfavorable price variance. All right, does that half make sense? Are we good
Yes.
so far?
Yeah.
Okay, now let's look at what we have on the cost. So over here on the quantity, now we're going to look at, we used 1,800 pounds. It was the actual quantity. We planned to use 1,750 pounds. We planned to spend $20, and we're going to put that in here as the standard price again, because now this is the difference. So now we're saying, okay, we plan to use 1,750 pounds, but we actually used 1,800 pounds. So we know that we're over on how much we used. So we know we have an unfavorable variance there. So when we take our 1,800 minus our 1,750, we have an additional 50 pounds, right? So 50 pounds gives us $1,000 unfavorable quantity variance. Now, if we looked at the financial statements, if we were just, where we would really start here is when we looked at the financial statements, this is what we would see. We would see on the financial statements that there's a $2,800 unfavorable variance. So we'd say, okay, we spent too much on materials. We spent $2,800 too much on materials. Then when we went in to do the analysis, we'd figure out it's because we paid $1 more than we planned, and we used 50 pounds more than we planned. So we have a problem with both our cost and our quantity. All right, are we okay here for the first go round?
Yes.
We're just looking at it once. Okay. So if we were looking at labor, it works exactly the same, except for with labor, we're talking about how much hours we work is our quantity, and the rate is what we pay per hour. So now, same golf clubs, except for we're saying that we produced, so this is actual. We produced 3,500 golf clubs, and we worked 3,400 hours. So if I did actual, I have 3,500 clubs, 3,400 hours at $16.50 an hour. That's my actual. Now, what I had planned to spend is direct labor, $1 per hour, 1 hour per unit at $16 per hour. So right off the bat, do I have a variance in how much I paid for my labor?
Yeah.
Yeah, I do. Is it favorable or unfavorable?
Favorable.
Unfavorable.
Unfavorable. I was looking at materials. Yeah.
Unfavorable, you're right. Because we actually paid $16.50. We planned to pay $16. So we know I have an unfavorable variance with that. Now let's think about how many hours we used. We actually used 3,400 hours. We plan to use 1 hour per club. We produced 3,500 clubs. So did I use more or less hours than I had planned? Wait a sec. Right, we used 3,500 out. We produced 3,500 clubs. What did I do wrong here? We produced 3,500 clubs. We worked 3,400 hours. We plan to work 1 hour per club. So how many hours did we plan to work? To make 3,500 clubs, how many hours did we plan to work? 3,500 hours, right. Daniel. We planned to work 3,500 hours. How many hours did we work?
3,400.
3,400. So do I have a variance?
Yes.
Yes.
Is it favorable or unfavorable?
Favorable.
Right. Okay, so now the thing is, the two can kind of mask each other. So now let's look at when we put it all together. So when we put it all together, we're looking at this, we're saying, okay, so our actual hours, we actually worked 3,400 hours. So we put both of those in, that's actual. And we plan to work 3,500 hours. We planned to pay $16 an hour. We did pay $16.50 an hour. So when we put all this together, instead of paying $16 an hour, we paid $16.50 an hour. So we paid an extra 50 cents an hour, which equates to paying $56,100 instead of $54,400. So that gave us the $1,700 unfavorable rate variance, the dollars. Over here, for the number of hours we used, we plan to use, we plan to end up with like spending $56,000 on labor because of planning on using 3,500 hours, but we only used 3,400. So we only spent $54,400. So that gave us a $1,600 favorable variance. Now, this is a really good example because if I was looking at the financial statements, the first thing I would see before I started doing any analysis at all was that my labor was $100 higher than I planned for it to be. That's the first thing I'd see. So it's easy to look at that and say, well, labor is only $100 higher than I planned for it to be. That's good. I mean, that's only $100, right? Why look at anything? But when you really start looking at it, then you realize, wait a minute, I paid more than I planned to pay, which gave me an unfavorable variance. But I also worked more efficiently than I planned to work, which gave me a favorable variance. So by separating the two, you can really see, okay, so do we need to, first of all, our efficiency, that's good. But do we need to look at, like, are we paying, overtime? Do we not have enough labor? What happened with the $16.50 instead of the 16? Because that's an opportunity to make our financial position even better. All right, are we good here? Okay. Overhead works exactly the same way. Here's the overhead rate. We did this at the very beginning of the class, remember? Remember that the overhead rate is based on an estimate. There we go. So this is based on an estimate. So we have, when we do our overhead, we're going to take the estimated overhead cost based on historical amounts divided by the estimated whatever our cost driver is, whether it's labor hours or machine hours or labor dollars. So we're going to take our estimated times estimated, and that gives us our rate. This is based 100% on estimates. When we go to apply the rate, then we take our rate times our actual activity. We're going to use the rate times our actual activity to actually apply it. To do our budget, we're going to use our rate times our budgeted. So you're going to take your estimated overhead divided by your estimated cost driver, and then multiply that by your standard activity. And we did that before. So now what we're going to do Okay, this is just looking at a flexible budget. And this is one of those things where I said, in the real world, we simply go in, if it was, 70%, we'd simply go and change our number in Excel, and there you go. Okay. So overhead variance works exactly the same way. It's just that we have the estimated rate. So we're still going to take what we estimated and compare it to what we actually spent. And we do it exactly the same. It's over and over again. So let's look at, I'm going to pull up, because we'll work through some. We'll review and then we'll work through some. I'll pull up our class. And I posted, nope, did it in the announcements. I put it here already. Okay. Yep, it's like, planning on not feeling good? I wrote everything out. Except for this time, I'm going to go for the numbers being correct. Okay. You can see the quiz review, right?
Yes.
Okay. Oh, shoot.
I wanted food that I was grown up enough to take care of them all by myself.
Okay, so let's review. We're going to start with how to build a budget. And the homework problems are just like this. They're just longer. So Cameron Court manufactures and sells electric staplers for $12.15 each. If 9,000 units were sold in December, and we predict a 5% growth in sales each month, how much will be sales for March? Okay, so how am I going to take, I have 9,000 units in December. And I need to go January, February, March. So if I have 9,000 units in December and I plan to grow 5% each month, how am I going to mathematically figure out how many units I have in January?
Multiply the 9,000 by 1.05.
Yep. $1.05. So in January, it's going to be 9,450. And then January, I'm going to take 9,450 times 1.05. So 992250.
Why is it 1.05?
Wow.
Because I expect it to go up 5%. So 5% equals 0.05. The way I can do that is I can say 9,000 times 0.05 and then add it to the 9,000, or I can say 9,000 times 1.05, and what that does is it gives me, it says, okay, take all of the 9,000 plus 5%. So, see, watch. If I did...
Oh, no, I get it now that you explained it.
Okay. So then in February, I have 99.22 times 1.05 is 10,418 units in March. Okay, so, but I want to know the dollar amount. So this is the number of units. Right? So now I'm going to say, okay, there's that. Now how do I get the dollar amount?
Multiply.
Multiply the sales units by 12.15 or
Yep.
the $12.50.
Yep. And that gives you your sales. Good there?
Yeah.
The next one is exactly like it with different numbers, obviously. Okay, so let's look at the end, see what we need to do. What is the budgeted materials needed in kilograms in the first quarter? So we have to know how many what materials do we need in the first quarter? So I'm going to say, all right, I know I'm going to need quarter 1, and I'm going to need quarter 2. All right, a sporting goods manufacturer budgets production of 57,000 pairs of ski boots in the first quarter. So we know that in the first quarter, we're going to produce 5,700 pairs of ski boots, right? But that's not materials. That's how many boots we're going to make. And 4,600 pairs in the second quarter. 46,000, sorry. Each pair of boots requires 3 kilograms of raw materials. So now I know that I need, for starters, 171,000 kilograms for this quarter and 138,000 kilograms for that quarter. Okay. The company aims to end each quarter with ending raw materials inventory, so ending inventory, equal to 25% of the following quarter's needs. So I need 25% of this left in ending inventory. So I need 34,500 kilograms in ending inventory. So I have to produce 171,000 kilograms. I need 171,000 kilograms to make the 57,000 boots. Plus, I need materials left over for the next period. So I want 34,500 kilograms for in ending inventory. Are we good there? Beginning inventory right now is 33,000. So when I started, I already had 33,000. So I don't have to produce that 33,000 because I already have it. So I'm going to subtract my beginning inventory. So if I take my 171,000 for my boots for quarter 1, and I add what I need to have in ending inventory for quarter 2, and I subtract the 33,000 that was already in my beginning inventory, I have to purchase 172,500 kilograms of materials. Oops. Does that make sense?
Yeah.
We're good there? That was a lot. Most of them are smaller. Okay. Number 4, sorry, slide 5, number 4. So what do we need to figure out? We need to, the desired ending inventory, budgeted purchases of product A. So we want to figure out budgeted purchases of product A for the year. We want to know how much we have to purchase for product A. All right, so we're going to look at this and we're going to say, the sales budget from Modesto Corporation shows that 20,000 units of product A and 24,000 units of product B. Does product B matter to us? Are we doing anything with product B?
No.
Nope,
No.
we're not doing anything with product B. So we can actually, that doesn't matter. 24,000 units of product B, that doesn't matter. Are going to be sold for 11 and 13, that doesn't matter. And the purchases, the selling price doesn't matter either. That's because we're not doing anything with sales, so none of this matters. The desired ending inventory of product A is 10% higher than its beginning inventory of 3,100 units. The beginning inventory of product B doesn't matter. This doesn't matter. Beginning inventory 3,100. Okay, and this is the desired ending inventory of B doesn't matter either. We're only worried about A. So what we're looking at here is, we're looking at, we want to have the 20,000 units. In ending inventory, we want 10% more than the 3,100. So let's see, what do we want in ending inventory? In ending inventory, we want 3,100 times 10% more. So in ending inventory, we want 3,410. Thank you. Units. So now we can say, all right, so what's the total budgeted purchases? So our sales are 20,000 units, so we have to purchase for that. Plus we need our ending inventory, so 3,410. But we don't have to make or buy what's already in our beginning inventory. So our beginning inventory is 3,100. So we can subtract that because we don't have to make it. So that means that we have to purchase a total of 20,310 units. Are we getting somewhere?
Yes.
This is a little bit longer. Okay, let's see. We want to figure out what is the budgeted materials in pounds for January. So I know that we're going to have to look at January and February because we have ending inventory, right? So I'm going to set this up for January and February. All right, Alliance Company's budgets production of 22,000 units in January. 22,000 units in January. And 26,000 in February. But that's not materials. Each finished unit requires 5 pounds of raw material. So to figure out materials, so for January, we actually need 110. And for February, we need 130. Sorry. All right, so we need 110 in materials, pounds, for our January production, and we're going to need 130 pounds for our February production. We don't have to worry about the cost because we're looking at pounds, not dollars. Each month's ending raw materials inventory should equal 30% of the budgeted next month's materials. So ending inventory in January should be 30% of what I need for February. So that means that my ending inventory, I need 39,000 pounds to start out February. So I need 110,000 pounds for what I'm going to produce for January. Plus, I want to end the month with 39,000 pounds in ending inventory to start production for February. At January 1st, so beginning inventory is 25,000 pounds. So when I started January, I already had 25,000 pounds. So I don't have to produce that or buy that. So that means that what I really need in January is 124,000 pounds. All right, are we good there?
Okay.
I have to go, stay here, look at this. I have to go refill my tea or I won't have a voice to talk with. I'll be right back. Okay. Number 6. Oh, this one's easy. So what do we want to figure out? We want total budgeted overhead to be reported. We want total, oh, this is the answer to the question that you asked at the beginning of class. Total budgeted overhead. Maybe not. Okay, so Flagstaff Company has budgeted production units for July of 10,000 units. So we're going to produce 10,000 units. Variable factory overhead is $1.50 per unit. Budgeted fixed factory overhead is $30,000. which includes $5,000 of factory equipment depreciation. So we want to know the total budgeted overhead to be reported. So first of all, this $30,000 fixed, that's part of overhead, right? We all agree with that.
Yes.
Do we need to do anything with this 5,000? I mean, that's overhead. It's in there in the 30,000. Is that appropriate?
I thought equipment depreciation was not included.
No, it is. It's part of overhead. What you're thinking is it factory equipment or is it like the office equipment? If it's office equipment, then it's not part of factory overhead, right? But depreciation is included.
Okay.
It's part of overhead. It is absolutely part of overhead. Glad we had this conversation. All right, so we want to know total overhead. So the first thing is, our variable overhead is going to be 10,000 units times $1.50 per unit, which gives us $15,000 in variable overhead. Our fixed factory overhead was given to us already in just 30,000. You just have to know that, go ahead and include the depreciation. So our total overhead is 45,000. See, that wasn't hard, was it? Yes, no, maybe?
No.
Okay.
Just a little well.
Hmm?
I guess I was thrown off by the 5,000.
There is a lot. I see a lot of like extraneous information in here. Like, I don't like that there's this question with $5,000 because that's like, I like the questions and I understand that it's important to test, like what information you need to pull out and use, but I don't like it when it's there to trick you, and this looks like it's there to trick you, so don't let it trick you. Depreciation belongs in there.
Okay.
So number 7, what are we going to do here? We want to figure out, compute the total selling expenses to be reported on the selling expense budget for the month of February. So we want to know, what is budgeted selling expenses what is budgeted selling expense for February? Okay, so Webster's Corporation budgeted sales for February are $350,000. Webster pays sales representatives a commission of 10% of the sales dollar. The company pays a sales manager a salary of $6,000 and expects advertising expense of $3,000 per month. So the first thing we have is we have the commission. So how am I going to figure out the amount of commission?
Multiply sales
Sales, right? So my 350,000
times 10%.
So I have 35,000 in commissions. And then I have 6,000 in my manager's salary. And I have 3,000 in advertising, that's part of selling. So I have a total of 44,000 in selling expenses. Good there? Are we good?
Yes.
Yes.
Yeah.
Number 8. Okay, so this has to do with expected cash receipts from current and prior credit sales for February. So we want to know cash in February. Okay, so we're looking at this and we're saying company's history indicates that 25% of its sales are for cash and the rest are on credit. Collections on credit sales are 25% in the month of the sale, 40% in the next month, 5% in the following month, and 5% is uncollectible. Now we know that December, January, and February. In December, we plan to sell 65,000. In January, 90,000. And in February, 100,000. All right, so we want to figure out cash receipts for February. So the first thing we're going to say is, well, in February, we have some of December's cash coming in. So this is the month of the sale. This is the 1 month after. This is 2 months after. So in February, are we going to collect anything from December?
Yes.
So
5%.
we're going to collect, right, the 65,000 times
0.05.
So that's 3,250. And then January sales, the 90,000, what percent of that are we going to collect in February?
40.
40. So we're going to collect 40% of that in February, and that's 36,000. And then February sales are 100,000. What percentage of these are we going to collect?
25.
So 25,000. So we're going to collect a total in cash in February of 64,250 from sales.
That's the total, right?
Mm-hmm. It asks you in February, what is the expected cash receipts from current and prior sales? Southland Company, what are we looking for? We want to know the preliminary cash balance at the end of August. So Southland Company is preparing a cash budget for August. The company has 17,000 cash at the beginning of August, so we'll start with that, right? And anticipates 150,000 in cash receipts. And 130,000 in cash disbursements. This is almost too easy. Southland Company wants to maintain a minimum cash balance of 10,000. So our preliminary cash balance is going to be $37,000. The loan amount doesn't matter here because we're asked for the preliminary cash balance before any loan activity. However, even if we were looking at the loan amount, we don't, would we do anything with the loan this month?
No.
We might repay some, but we're not going to borrow any, right? Because we have more than $10,000. That one was simple. Okay, now we're going into the stuff that we just started tonight. So now we get to put our thinking caps on. Company provided the following direct materials cost information. We want to know the total direct material cost variance. So we're looking for total and we're looking for cost. So the first thing that we're going to do is we're going to say, okay, how much, so what do we have? We have standard, so this is the budget, right? And this is actual. So we budgeted, we planned to spend $800,000. We did spend $902,000. So we're looking at the total. So all we have to do here is say, we actually spent $902,000. We plan to spend
800.
$800,000.
Cost variance of 102.
Mm-hmm. But then, is it favorable or unfavorable?
Actual exceeds unfavorable.
It's unfavorable because we actually spent more than we had planned to.
When actual exceeds budgeted.
The actual exceeds budgeted. So it's 102,000 unfavorable.
Seems also like when we did on the practice or homework where it was seemed harder.
Well, it was new too. Oh, the homework is harder than the test. because the homework, especially with this unit, because with budgets and variance analysis, there's tons of pieces and you can't test tons of pieces all together. So you have to break it into pieces to test it. So the test is actually, the test is easier than the homework. We're going to do this and we'll take a 10-minute break. Okay, so number 11. So now what we're trying to do, the sales, we want to know how much sales should be if the company produced and sells 18,000 units. We want to know how much sales dollars should be. So we know that that the company's flexible budget for 15,000 units showed 120,000 in sales, 70,000 in variable costs, and fixed costs of 15,000. So what we have here is we have for 15,000 units, we have sales of 120,000, variable costs of 70,000, fixed costs of 15,000. We want to know what would this be if we sold 18,000 units. So the way when we want to know what is the sales that we expect. So we're looking at what is the sales dollar. So what we're going to do is, the first thing we have to do is we have to figure out, well, how much did we sell it for? We know how many units we sold and we know the total in sales dollars. But the piece I'm missing is, how much did we sell it for? So how do I figure out how much I sell it for per unit?
Isn't it just sales divided by units?
Yep, that's all it is. I have 120,000 units. Sorry, $120,000, and that was for 15,000 units. So my sales price per unit is $8. So now I know my per unit sales price. So all I'm going to do here is I'm going to take 18,000 units times $8 equals 144,000. That's all I have to do. I just have to know that I have to figure out how much my sales dollars are per unit. Okay. Let's take a 10-minute break. We'll come back and we'll keep going. So come back at like 1:15 and we'll keep going. Sound good?
Yes.
All right. I'll be right back too.
Thanks.
Okay. Like 1 minute left. Oh, this is one like where you were talking about overhead percentage. This is the one I was thinking of. I knew I'd done one like it. Good God. Okay. All right. So now we want to figure out the budgeted amounts of fixed and variable costs for 15,000 units. So this is kind of like what we just did, where our number of units are changing. So the first thing so we want budgeted fixed and variable costs. So let's look at what we know. Based on a predicted level of production and sales of 13,000 units, a company anticipates reporting operating income of 30,000 after deducting variable costs of 70 and fixed costs of 10. So we want to figure out, based on this information, what is the budgeted amounts of fixed and variable costs for 15,000 units? So the first thing that we have to do is we're going to have to figure out what is our fixed overhead per unit. So, because we have fixed and variable. So we have to convert everything to units, or we can't make the jump from 13,000 units to 15,000 units. So if our fixed overhead per unit is, if our fixed overhead is $10,000, how many units was that for? Originally, we did 13,000 units, right? Are you guys with me? Our fixed overhead is $10,000. We spent that to produce 13,000 units. So our fixed cost per unit is fixed overhead is 0.77 cents. So now I know what my fixed overhead per unit is. Now I'm going to have to figure out my variable overhead per unit. So my total variable costs are $70,000. And I did that to make 13,000 units. So my variable cost per unit is $5.38. So I had to convert them to units because now I have to figure out, instead of making 13,000 units, what happens if I make 15,000? So now I'm going to say, okay, so if I make 15,000 units, my fixed overhead would be 15,000 times what?
Times 0.77?
Yep, times 0.77. And that is 80,000 fixed overhead. That is 11,550. And my variable overhead is 15,000 units times $5.38 per unit. So my variable overhead is 80,700. So my total overhead, actually it doesn't ask for total, it asks for fixed and variable. So you're going to do both of those. All right, so I knew the total. So the first thing I had to do is break it down into per unit so that I could then figure out what it would be if I had, instead of 13,000 units, 15,000. All right, are we good here?
Yes.
Okay. Oh, number 13. Okay. So we want to figure out
Actual cost and direct materials.
yeah, that's okay. Okay, got it. I'm like, wait a minute. I know I copied it all. The actual cost of direct materials. So we're given the budget, right? This is the budget because it says standard. So our budget is we plan to spend, we plan to use £1 at $3 per pound per unit. So we plan to spend $4 per unit on materials. We had a unfavorable variance of $20,000. We actually used 60,000 pounds and we actually produced 30,000 units. So we have to back into this. So we're going to say, all right, let's start with our budget. So we want to know what the actual cost of direct materials were. So we know our budget and we know the variance. So those two together will give us our actual. So the budget was $4 per unit times 30,000 units. So we plan to spend $120,000. That was our budget. We have an unfavorable variance of $20,000. So if we have an unfavorable variance, did we spend more or less than what we planned to spend?
More.
Spent more.
We spent more. So we spent $20,000 more than what we planned to spend. So we actually spent $140,000. That make sense? $14. This is a little bit longer. So we want to figure out what is the total labor cost variance. So we're looking at how much more or less did we spend on labor than we had planned to spend. Okay, so a job was budgeted to require 2 hours of labor per unit at $11.25 per hour. The job consisted of 9,500 units and was completed in 17,000 hours at a total labor cost of $190,000. Okay, so we have a lot of information there. So let's make sense of it. So our budget for cost was $11.25 per hour. We're given that. Now, what we aren't given is what our actual cost was, because we're only looking at cost. So we're told what our budget was, but what was our actual cost? Well, we know that we spent $190,000 on labor for 17,000 hours. So how can I take that information and figure out what my actual per hour amount is? We had a labor cost of $190,000 and we spent 17,000 hours working. So how do I get a per hour amount?
Actual minus budgeted.
Wait a minute. No, first, so I know what my budget is. My budget was $11.25 per hour, but I don't know what my actual per hour rate was that I paid.
So
I do know.
Divided
Right.
by the
Yes.
hours.
Yes, cost divided by hours. I know the total amount is $190,000, and I know that we actually worked 17,000 hours. So my actual amount that I paid per hour is $11.18 per hour. So right there, do I have a favorable variance or an unfavorable variance? I plan to spend $11.25 per hour. I actually spent $11.18 per hour.
Favorable.
Yeah, I actually, we know I'm going to have a favorable variance. But now I need to figure out the total dollar amount. Okay, so we planned to spend $11.25. We spent $11.18. So the difference is 7 cents. We worked for 17,000 hours. So 7 cents by 17,000 hours is a total cost of $1,190. So our variance would be $1,190, and it's going to be favorable. Are we good there? Okay, now we want to know what is the actual total direct materials cost for the current period. Actual total direct materials cost. Okay, so Sanchez, this is like when we just worked. Sanchez Company's output for the current period was assigned a $400,000 standard direct material cost. So this is our budget. We plan to have direct material cost of $400,000. The direct materials variance included a $10,000 favorable variance for price and a $7,000 unfavorable quantity variance. So we know that those two combine together, right? So if I have a favorable variance of 7,000, a favorable variance of 10,000 and an unfavorable variance of 7,000, what am I going to end up with?
$3,000 favorable variance.
Right, $3,000 favorable variance. So when I take this, I'm going to say, all right, my standard, my budgeted direct material cost that I started out with was 400,000. That was what we planned. We're going to subtract my favorable variance, because my favorable variance means that I spent less than my budget. So we're going to subtract the $10,000, and we're going to add the unfavorable variance, because the unfavorable variance means I spent more than I planned. So I'm going to add the 7,000. So I end up with $397,000 is my actual direct materials cost. All right, good there? Oops, that didn't work very well, did it? Okay, looks like a lot of information here, but it's really not hard because we're not going to use all of it. So we want to figure out the fixed overhead cost variance. Fixed overhead cost variance. So Fletcher Company collected the following data regarding the production of one of its products. We just want to compute the fixed overhead cost variance. So to get the variance, we have to have actual, and then we have to have the budgeted amount, right? So we have the direct labor cost, the actual direct labor hours, the number of units that we plan to produce, the number of units that we did produce, the overhead rate that we budgeted for variable, the fixed overhead rate that we budgeted, and the actual overhead that we incurred. So the first thing we have is we have the actual fixed overhead, and they give that to us. So they give us the actual fixed overhead. So that's what we're going to start with. We're going to say, okay, so the actual fixed overhead is 500,000. Now we want the fixed overhead cost variance. So we need to know what was our budgeted amount. So our budgeted amount to get the budget or the standard, they don't give us that. So we're going to have to calculate it. What we do know is that our standard overhead rate is $9.20 per unit. And we do know that we actually produced 46,500 units. So we can figure out what our actual budgeted amount was. So we're going to take our actual finished units, 46,500, times our budgeted rate of $9.20 per unit, gives us 427,800, and this would be our budget. So now we say, okay, our actual overhead was 500,000. Our budget was 427,800. So right off the bat, do I have a favorable or an unfavorable variance?
Unfavorable.
Unfavorable. Because I actually spent more than I planned. So I have an unfavorable variance. Oh, we'll use the formula for this one. Okay, for this one, we want to figure out the sales price variance. So we're going to use our formula. So for our formula, we need to figure out our actual sales times our actual price. So Claremont Company specializes in selling refurbished copiers. During the month, the company sold 150 copiers for a total sales of 375,000. The budget was to sell 160 copiers for $3,000 each. So we have to break the 375,000 down into units. So we know that we spent $375,000, or we had sales of $375,000. Now we want to figure out, what did we plan to have? So what we plan to have we plan to make $3,000 per copier and sell 160 copiers. So we planned to have sales of 450,000. So now we have our budget, our plan was $450,000 in sales. Our actual sales is $375,000. So that means that we have a $75,000 difference. And is the variance favorable or unfavorable? The heck?
Unfavorable.
Yeah, because it's sales. Yeah, it's sales. So you want it to be higher. Okay. 18. All right, so we want to figure out departmental delivery expenses for Department Y and Department Z. So I know that we're going to need Y and Z. Okay, so we need to figure out the delivery expenses for Y and Z. Well, let's see what we have. The company has two departments, Y and Z, that incur delivery expense. An analysis of the total delivery expense of 14,000 indicates that Y had a direct expense of 1,500. Okay, so let's fill that in. 1,500 for deliveries, and Department Z had no direct expense. Okay. The indirect expenses are 125,000. The analysis also indicates that 50% of the regular delivery request originated in Y and 50% originated in Z. So we're going to say, all right, so for indirect expenses, we have for Y, $12,500 times 50%. So we have $6,250. And indirect for Z is going to be the same because they divide it the same. $12,500. Deliveries times 50%, 6,250. So the total fees for Y is 7,750, and the total fees for Z is 6,250. It's just piecing it. If you keep asking yourself, if you struggle with one, if you keep asking yourself like, well, what do I know? And write down what you know, then it's easier to figure out from what you know what you don't know. So you just keep asking yourself, well, what do I know? And as you start putting the pieces together, you'll realize, oh, wait a sec, I have the whole picture here. 19. Oh, this is just a ratio. This is just a formula. We want to do return on investment. So return on investment is sales minus cost of goods sold minus operating expenses divided by our average total assets. Because we want to figure out how hard are the assets working for us. Holo Company reported the following financial numbers for one of its divisions for the year. The average total assets of $6 million. Sales of $5,800,000. Cost of goods sold of $3 million. And operating expenses of $1 million. So that equals 1,800,000 divided by 6 million, which equals 0.3 or 30%. Just a financial ratio. Are we good there? Number 20, we're figuring out the profit margin. Profit margin is income divided by sales. In other words, how much of the sales dollars do we get to put in our pocket as profit? Average invested assets of 650,000 don't matter. Sales of 1 million, so we'll put 1 million down here. And income of 150,000. So our profit margin is 0.15 or 15%. How do we know if that's good or not? How do we know if 15% is good or not? Okay, so think about it. If you had a business and you wanted to know, is this the amount of profit that I should expect to be getting? How would you know if it was a reasonable amount for your industry or not? Compared to last year, that's one way. Yep, one way is that we can look at the trend and we can see, is it increasing or is it decreasing? What else can you do? It's like 15%. If I was in the grocery business, 15% would be awesome, right? Because nobody gets 15% on groceries. But if I was in the jewelry business or the car sales business, then 15% isn't very good at all. So how do I know if 15% is good?
Comparing with your competitors.
Compare it with my competitors. You can either compare against, it's called benchmarking. You can compare against an industry standard, which all industries publish them, or you can compare against your competitor to see if it's a reasonable amount or not. For 21, you have to calculate return on investment. I gave you the formula. The problem has a ton of numbers. And so you just have to find these numbers. I started copying them here and it wasn't working. Number 22, still too much data. So you have to calculate allocated salaries. So you have to figure out allocated salaries. In other words, how much salaries did we use for this job? And to do that, you're going to take the total salaries that you spent times, you want to figure out how much did you use in this particular department. So you're going to take the number of employees in this department divided by the total employees. Because if you take the number in, like, for instance, Department A divided by the total number, you end up with the percent that goes to A, right? So we're going to take our total salaries and multiply that by whatever department we're looking at divided by the total number of employees. And that'll give us the percent times the salaries for that particular department. Number 23. So number 23, we want to figure out the amount of admin expenses that should be allocated to the assembly department for the current period. We're going to do this the same way with the ratio that I just explained with the number of employees. So Ready Company has two operating or production departments, assembly and painting. So we have the assembly department and the painting department. The assembly department has 250 employees and occupies 50,400 square feet. The painting department has 50 employees and occupies 33,600 square feet. The indirect expenses are 90,000 for admin and 102,000 for maintenance. Administration is allocated based on workers in each department. So we don't care about the square feet. Instead, what we care about is total employees is 250. Wait, no, assembly has 250. Painting has 50. So the total employees are 300. So this is allocated based on the number of workers in each department. So if we want to know what's going to be allocated to the assembly department, we say, okay, the assembly department has 250 out of the 300 employees. So we're going to take we're only looking at admin. So we're not worried about maintenance. We're only worried about this one. So we're going to take our admin cost of 90,000. And now we have to figure out how much gets allocated to assembly times 250 out of 300 is the percentage that goes to the assembly department. So we're going to allocate 75,000. I'm like, that's wrong. $75,000 of the 90,000 is going to go to assembly. Does that make sense how we did the ratio?
Yes.
Okay, good. Okay. Now we want to figure out Do I not have what I want to figure out? Oh. We want to know department number 1's contribution to overhead as a % of sales. So we're looking at the department 1. Okay, so we want to know overhead as a % of sales. So we're going to say, to figure out overhead, because they don't give us just overhead, we're going to have to take sales minus cost of goods sold, because that's not overhead, minus my direct expenses will give us the overhead. So sales of 120,000 minus cost of goods sold of 720,000 minus direct expenses of 120,000 equals 360,000 to go to overhead. So now I'm going to figure out, well, what percentage goes to department 1? Well, I'm dividing it up based on sales. So based on sales, wait a minute, based on sales, I want to know what percentage as a % of sales. So I'm going to say, all right, my overhead divided by my sales. So I have 360,000 because I want to know what % of sale, what % of sales is this? And my sales is 1,200,000. So my overhead is 30% in department 1. And you're going to be really happy that I was feeling so sick by the time I finished this that I just put the answer worked here. Okay. So, what else? What other questions do you have? Do you want to look at that homework problem? We're being really quiet.
Sure.
Synchronous. God. Hold on, I'm saving. So nothing happens to it. Okay, that's done. Now, let's look at the homework. So I know a couple of you have asked questions. So which homework problem in particular are you struggling with?
I was having issues with 4 and 5 on 4 part 3. The rest of it's pretty simple, but the overhead part was, I got lost.
Okay.
I'm pretty sure it's something simple. I just
Probably.
couldn't find it. What I was looking for.
That's weird. Maybe I'll log back in again. Seriously. Okay. Okay, I'm going to pull somebody's up. Let's see. Who had a question about 4 and 5, the overhead? Who said that?
It was me, David.
Can I pull yours up?
Sure.
This is really waiting. Okay.
Are we going over the project at all that's due next week?
Oh, yeah, that. Yeah, let me look at this and we'll go look at that. It's like no big deal after my class. Okay, so apparently this isn't going to cooperate with me. McGraw-Hill does not want to pull anything up. So I guess I'll have to answer questions individually tomorrow.
I might be fine after today anyway. I have to look at it again though.
Okay, so the paper. It's not really a paper. Not my idea. All right, can you see the course outline?
Yes.
Oh, good. Okay. So the course project. Introduce you to the Institute of Management Accountants. So you're going to go to the website for the Institute of Management Accountants, and the link is already here. All you're doing is go find this information and show me that you found it. So all you're going to do, seriously, he said Times New Roman and 11-point font. Please use 12. And you know what? If you can answer the questions, 3 to 4 pages has nothing to do with anything. So who and what is the Institute of Management Accountants? What is their mission? How many members are there? and where are they located? What's the closest chapter to your home? What is the CMA certification? Like there's the CPA, which is Certified Public Accountant, and then CMA is Certified Managerial Accountant. So what is that? What are some of the benefits of the certification? What does it take to get certified? Are there any continuing education requirements? What is the average salary advantage of having a CMA license? And what's the difference between a CMA and a CPA certification? This was not my idea. So just go find the information. See, no big deal, right? Not like the paper I had you write. Okay, any questions now that we looked at it?
No, just wanted to know what you were looking for.
Yeah, I'm looking for you to do well on the final exam. Not my idea. I like papers. Did I say again, not my idea? Does this look like my idea? No. Why in the world does it say 11-point font? That makes no sense. That's not APA, that's not MLA. Okay. Do well on the final. Put information down for this. Okay. Call me if you have questions tomorrow. Remember, you guys remember that, and I'm home all day Saturday. My husband's at a robotics competition. But remember the time difference. So you can't wait until the very last minute and try to ask me a question at midnight my time, because I won't be up to answer you. So when you're studying and getting ready to take the quiz, just remember the time difference so that you get all of your questions answered if you need them. Other than that, I'll be around all day tomorrow, all day Saturday, all day Sunday, preferably in bed. So if you have questions, call me, text me. Much faster than emailing me. I check email, but only about once a day. Okay, anything else before we go?
Just a quick question. For the homework, I know you weren't able to log into it. For question 1, is there any way that you can just add a hint button? There's so much information in this one question. I've been working on it probably, I don't know, two and a half days, and there's a lot.
Okay, that's not my intent. So my options are. Wait, oh shoot, that's part of the reason. Resources. Hints. Well, you should have hints. So you should have already had hints.
It's not there. I mean, I saw on your screen it's checked ebook print and references.
Mm-hmm. Also, you have unlimited attempts, but when you're spending that much time on something, that's not the intent. Plus, with this stuff, if you start spending that much time, you end up just running on a little hamster wheel, right? You're finally just like stabbing at numbers, trying to figure it out. So where does hint usually show up?
Okay.
Down to the side where ebook and print is.
Over here? And it's still not saying that, is it? Let's see. Oh, that's why. Now let's see.
Whoa.
Now it's not saying anything. Oh, that's because I'm in preview. Oh, now we can look at it. Yeah, you know what else? I wouldn't have put these huge problems on here. So you can go back and look at this for 6. I'm almost done. I'm almost done, yeah. Yeah, if you find that you are like you've got most of it and you're spinning your wheels, definitely call me. But also, if you feel like you've got most of it and you understand it and you're spinning your wheels, when I look at the grades, I always add points if you're close, and especially here because these are really long problems, and they're hard to work on the computer like this. So, so I think that so that's not the intent. Don't spin your wheels to that extent.
Okay. Yeah, because number 1 has 10 different tabs.
Yeah, that's totally right. That's totally. It still doesn't say hints. See if it says hints when you go in there. I gave you unlimited attempts. Yeah, if you feel like you're spinning your wheels, there's a problem. That's not the intent. And these are really long. I don't think I would have done ones that are this long. Yeah. So if you're doing that, that's not. Think about what we did for the test. Think about what you've learned. Do you feel like you understand it? Because if you get lost in these problems, you're going to confuse yourself and just keep trying to figure out what the next right number is, and that's not going to have any value. So so I'm happy to bump the score up when you get most of it. All right. Other than that, you can call me tomorrow. Now apparently I can see it. Okay. And I'm hoping hints show up after I log out and back in, because I said hints. And I gave you unlimited attempts, and I made it where it stays the same problem. And it gives you detailed feedback after each submission. So you can submit and go back and resubmit again. Okay? And it won't change all the numbers. I hate that. All right, so call me if you have questions tomorrow. Sound good?
Yes, thank you.
All right. I will see you guys on Tuesday. Have a good weekend. Call me if you have questions. I'll be here feeling sick. It's not available for homework. That makes sense. Okay, but I went ahead and changed the feedback so it's detailed, and so the numbers don't change, and gave you unlimited attempts. All right, I will see you on Tuesday.